So when we look at the equity market, obviously we saw this enormous decline and then this rapid rise. We're at a really interesting point. The common question I get from clients is, how could the market come all the way back and be positive or be neutral, given we have so much stress still in the economic system? And my response is, it hasn't. We are seeing an anomaly in the market that I have not seen since 1999, where a small group of stocks is running the whole market. We're going to look at that data. But the reality is the broad markets are still down, and still down a healthy amount. Yes, there's still value in this market. It's just you can't just look at the S&P and the NASDAQ because they are completely skewed by a small number. I would also point out, remember, when you're thinking about the stock market is not the everyday economy. And so sometimes the stock market, the businesses that dominate the market, they're kind of separated from the everyday economy. And so we can't necessarily correlate those together, AKA Amazon and Microsoft and Google. That's not mom and pop barbershop or restaurant. So there is a disconnect. There's a disconnect between the big stocks and the main market. There's a disconnect between Main Street economy and the stock market as a whole. So we need to dig in and ask the question, after this run-up, is this still a good time to own equities? And our response is, it's a much better time now than it is to own other asset classes, but mind the risk, watch what's happening. So let's take a look at why we think that. Here's a couple points. Point number one, as this chart shows, massive stimulus. The Fed has a lot of money, and obviously, historically, that's a really good time to own equities. Don't fight the Fed is the saying we hear. Relative to bonds, equities look very good. This is the earning yields on equities. So in other words, take the earnings over the stock price, you get a yield to investors. Look at the difference, much higher than bonds. Equities are more favorable. The speed of the rally is one of the most impressive in history. That dark red line, it's a very busy chart, but the dark red line is the current rally. It's rallying higher and faster than it has in any time in history. But I will caution you, that includes those big stocks, so not all of them are actually rallying at that level. So let's dig into that. Are we in a bubble? What about those big tech stock names? This, if we were to say where we would caution investors, this is where it is. The valuation of a handful of names is really starting to reach that, that overly euphoric sense that you get sometimes in bull markets. In fact, I'm starting to hear what I heard in 1999. PE doesn't matter. Valuation doesn't matter. All that matters is the growth story and the enterprise value and buy the story. And that's the way it's always going to be. When you hear these absolutes, take caution. This next chart shows you some of the great bubbles in history. The Nikkei index in Japan, which was an enormous, it took Japan down for decades. And you see there the PE, that's one of the all-time greatest. But then take a look at the next few. The red boxed bar is actually today's top 5 stocks in the S&P 500. The U.S. Nifty 50, which was in the 70s, a great overpriced bubble. Tech stocks today, the NASDAQ 100 today, is equal to where we were in the 99-2000 tech crash. So we are starting to get to some elevated levels. It's something we need to watch and take caution. And that is always the case. Discipline in a portfolio. Don't let your portfolio allocations get too crazy in these areas. And then you look at telecom back in the 90s. Look where the S&P 500 is today. And then you have the home builders and the financials from the 2009, much, much lower peak levels. This tells us to be careful. A couple other statistics quickly. The top 5 stocks now represent 20% of the S&P 500, over 20. It's an all-time high. Also, when you hear today that the S&P 500 is above break even, again, if we were to take an equal weighted S&P 500 and we just looked at all of those, all have the same weighting as opposed to the market cap weighted that the S&P is, the S&P 500 would actually be down 10%. Okay, so this is a little deceiving, and so something to take note of. Over the next 12 to 18 months, it's selectivity. There is value in the market. If we look at this chart that shows the global equity outlook, this is, I think, a great chart. As you go down this list and you look at growth indices, the Russell growth, the Russell value, the S&P 500, you'll see the percentage down from the 52-week high and the rally that's already occurred. So what do we see? Value is still down 23% on the 2,000 value. The Russell 1,000 value is down. The Russell 2,500 down 21%. So the S&P, as of the end of the quarter, is only down 5, but there's still a lot of damage in this market. Even though, look at these rallies off the lows, 40, 50% off the low. A lot of water to carry here. We do like global equities as well. We are weighted very significantly in the international markets. This next chart shows relative value. Back in '07, in the last crash, international was expensive. U.S. has done extraordinarily well had we followed this chart. Now you look today, it's as inexpensive as it has been in history, and we are seeing Europe rally, and we actually are seeing them recover faster than the U.S. So in terms of equity, again, mind your allocations, be cognizant of the risk that's involved here, but also it's time to separate and break apart the markets. Active management is really going to be important as we come out of this moment in the market's history.